Nick, so glad we have time to talk today. We're going to talk through 3 financial planning and investment opportunities in a down market, which we, of course, are in right now. Recently, the U.S. stock market saw the biggest 2-day wipeout in history, $6.6 trillion. In fact, the market has lost $11 trillion since Inauguration Day. Now, before we get into how to take advantage of it, I do want to talk through what's going on. This is something that you and I have talked about before, the concentration risk in the market, where 80% of the market's movements due to just 10 stocks. Now, to see that in a different way, this is a look at the S&P's 1-month performance. And the Mag 7 alone have lost $2 trillion since the start of the year. But Nick, when we see this much red on the board, what do we need to keep in mind?
Well, real diversification is your shield. If you were all in the stock market, granted, you'd look at that and say, oh my gosh, all my money is affected. But in reality, that's not the way it should be. That would be like going to a casino and saying, I'm going to put all my money on this one hand. And something I'll tell people is you don't want to be the Titanic. Real diversification would be like owning a car, a bike, an airplane, maybe even a boat. Different vehicles are going to work under different circumstances. And so, again, how I look at that is if you only had a boat and there's tons of icebergs out there, the Titanic people would have survived if they had planes and flew over it. They certainly had enough money back then to be able to do it. So if it's flooding around my house, then I don't want to get in a car and I can't ride a bike. So I'd want to use a boat in that regard. So again, different vehicles do different things. And when 10 stocks drive 80% of the returns, it's, it's like having all your money in different rooms of the Titanic. Just imagine that what you have there. Imagine those are little rooms. The big red ones are like the suites, the mega suites. And then you have the smaller little ones. Those are like the interior staterooms. It doesn't matter. It all pretty much gets affected. So if the boat's going down, everything's getting affected. But if you're investing in other things outside of that boat, you might be okay. And in the financial world, what that means is diversify your money between things in the stock market. Also, don't be afraid to get into alternative strategies and even principal protected strategies. So that if 80% of everything goes down because of those 10 companies, it might affect your stock market money, but not the other money that you have.
Yeah, this is a good reminder that just putting your money in the S&P is not a financial plan, which is what I know you design. And I'm glad we got to talk that through. So now let's get into some of the tips then to take advantage of this down market. Number 1, put your cash to work. As I always say, it might feel better to hide all of your cash under the mattress. But Nick, as we've talked about many times before, if you sit in cash, it really compromises your ability to build wealth. This blue mountain on the top is if you're invested in the S&P. The blue line in the middle is essentially bonds. And that black line's T-bills. That's cash.
Yeah. I mean, cash is comforting during times when we have market volatility and it increases, but it's also dragging the long term. So if inflation is 3 to 4% and you're earning 1% in the bank, you're losing money safely. And something that I'm seeing a lot of people do is they're starting to move money into, or have moved money into CDs and money market accounts. And they're under this assumption that those CD rates and those money market rates that are now higher than they've been in the last 10 years are going to stay at that level forever. That's not the case. It does not stay there. The Fed has come out and talked about how they want to cut those rates down. And what that means is so those CD rates are going to go down. The money market rates are going to go down. So now is an opportunity to try and lock in these better returns for a longer period of time while you can. And so, but the thing is, you're right. The inflation, if it's 3 to 4%, you're earning 1%, that doesn't really do anything. And when the market drops, how I look at that is it's almost like a Black Friday sale. Okay. Great companies go on sale. The markets have been wild right now. We know that. And so you might be able to buy something. And this is the thing too, is you might be able to buy something maybe 10% off right now. But what ends up happening is people freeze because the market's down and it's a 10% discount from where it was. But then they start thinking, well, it could go down another 20% or 30%. Where's the bottom fall? And so what ends up happening is they freeze and they sometimes don't invest for years and years and years because they don't know where the bottom's going to fall. And so just like you have here, this is the emotional roller coaster ride, so to speak, that people go on. So if you're nervous about jumping all in, here's a suggestion: drip it in. I watched a movie recently, The Matrix, with my son. He's kind of into that sci-fi stuff, and so we watched The Matrix, and in that movie, there's a couple scenes where Neo, the main character, jumps off a building. I'm not saying jump off the building, like jump everything you have in the market, drip it in, take the stairs, down, buy a little bit.
How will you know if you're the one unless you jump off the building?
Well, that's true, right?
Sorry.
So, but I mean, the thing is dollar cost average your way in. As the market's falling, buy a little bit. Then as the market keeps stair stepping down, buy a little bit more and buy a little bit more. Don't try and time the market, because it's time in the market that matters, not timing the market.
Mm-hmm. Such a good movie though, isn't it?
It is a good movie.
Did your son like it?
I like the first one. I like the second one. The third one was a little okay. And the fourth one, I haven't had the time or the desire to watch because the reviews on it were so bad. So I guess I just didn't watch it. But the first two were really good. Yeah,
there. Okay. Now, next, you say take advantage of all these stock losses and consider tax loss harvesting. Now, Nick, this is something that you and I have talked about generally towards the end of the year, but why don't you explain how this works?
Well, and there's a couple opportunities that you can do midstream as opposed to waiting until the end of the year. Tax loss harvesting is definitely one of them. And this is where you're essentially turning lemons into lemonade. Tax loss harvesting is one of those rare moments where losing can actually help you win. You can actually sell losing investments, lock in those losses, and then use that money to offset capital gains and reduce maybe your regular income up to $3,000 a year. And anything that you don't use gets carried over into the following year, or actually indefinitely if you had a lot of losses. There's, Again, I hate going back to movies. I mean, I've watched Moneyball and Miracle come to mind when I watch this, because in both of those movies, the coach decides he's going to make this strategic decision to not pick the most popular player, but to pick the right player. And what that means is some of the popular players, and especially in the movie Miracle, for Russell, he's trying to create this Olympic team that's going to win hockey. And he ends up getting rid of the big name players and build a team with unknowns, but who he thinks can work together. And so it's almost like that. There's going to be times when you look at your stock, and you're like, man, this one sounded good, but it's not. Or this one's been on the news a lot, and it's a loser. Now is an opportunity to take and get rid of that one. Use those losses to maybe get out of something else that you have at a profit. And then that way it can help with that. So that's what they call tax loss harvesting. Great opportunity right now to do that.
Okay. And then last, can you explain why a Roth conversion makes more sense in a negative market?
So this is a strategy. I just did 2 live events this week, and we talked about how it's almost like when the market goes down, look at it as if the market goes down in an IRA or a 401k, that's all pre-tax dollars. So the market goes down and then it rebounds typically. Well, when it rebounds, it's still you're still building your tax deferred bucket, your tax later money. It's going to be taxed down the road. But if the market is down and then you take some of that money and you convert it, now when the market springs back, you're creating tax-free wealth. And so now is an opportunity to do Roth conversions. Essentially taking that money and moving it now while the market's down over to, pay taxes at a lower amount. It's still the same tax bracket, but you're converting money, you're converting it at lower amounts, sliding it over to a tax never bucket. And now whatever that grows back to as it rebounds, you're creating tax-free wealth. So now is a wonderful opportunity to do Roth conversions. I look at that as like there's a game, your kids probably play it too, if they have like a Nintendo Switch, called Mario Kart. I don't know if you know that one. You know that game?
Everybody knows Mario Kart.
Everybody knows Mario Kart.
That's from when we were kids though too, Nick. So
it is. And if you hit that specific coin or token or whatever, you can build up boost power. And then when you hit that button, your car really takes off. Well, this is almost like that opportunity. Is if you can convert that money over when the market does in fact spring back, it's like exploding your tax-free wealth and creating this tax-free bucket that maybe you didn't have before.
Nick, you have the absolute best analogies. It all makes so much more sense after I get to talk to you. So thank you for breaking down these opportunities. I love, hearing about the silver lining and all this. If somebody wants to talk through any of these strategies, or just to make sure they are properly diversified, that they have a financial plan that is designed to capitalize on this volatility, what's the best way to reach you?
They can always go to our website, group10financial.com. Lots of information and our contact information, even our online calendar to schedule a quick 15-minute strategy session call. And especially right now with everything going on, I think a missing component is people have not stress tested their money. So they're surprised because the market's down, they're down, maybe more so than they thought, and they're trying to figure out how did that happen? And it all should start with stress tests. It's kind of like, sometimes if you have a heart problem, the writing was on the wall years ago, but you ignored the signs, or maybe you didn't want to go to the doctor. And so now's an opportunity now, because we're still kind of at a market peak. It's pulled back a little bit, but it could be worse, and it could get worse. Now's an opportunity to take advantage while there's a window of opportunity.
Yeah, really good advice. All right, Nick, thank you so much for your time today. I appreciate it.
Great being with you.